Welcome to Wealthy Behavior, talking money and wealth with Heritage Financial, the podcast that digs into the topics, strategies, and behaviors that help busy and successful people build and protect their personal wealth. I'm your host, Sammy Azzouz, the president and CEO of Heritage Financial, a Boston-based wealth management firm working with high net worth families across the country for longer than 25 years. Now let's talk about the wealthy behaviors that are key to a rich life. Welcome to the March investment edition of the Wealthy Behavior Podcast, where I talk to our Chief Investment Officer, Bob Weisse, about what's going on in the investment world that you need to know right now. Bob, so there's a lot going on as usual, but a couple of interesting things in the market, given the tensions in the Middle East. We're going to touch on fixed income, and then we had a listener question about this Cetrini Research post that's making its way around the internet and getting a lot of attention. So with that introduction, anything on your mind in terms of what's going on these days?
That's a good list, and the Cetrini Research report, whether people are familiar with that or just more familiar with AI and trying to think through the economic implications of it, I think might be a good place to start.
You want to start with the research post?
Sure.
Yeah. All right. So it's the 2028 Global Intelligence Crisis, and that's the name of the post. Cetrini Research is an investment research firm. I hadn't heard of them until now, so if their goal was to get attention, mission accomplished. But it's a thought-provoking piece, and as I've mentioned more than once already, it's getting a lot of attention. I think some things to mention at the outset is, it's specifically created to look at the tail risk of the AI scenario, and it's not a projection. It's looking at almost like what could a worst case scenario be? What's a 10 to 15%, likelihood outcome, instead of, hey, this is what we think is going to happen. But you think about things like that through this lens, and it can be helpful. So what were your thoughts as you digested it? We had a listener who asked us to touch on it.
Yeah, there's a lot to dig in there. First, maybe just laying the foundation. Cetrini Research, they're a research firm, also manage money and do short selling. So they have an incentive to scare people. Short selling is betting against the market. So that's just one kind of thing to keep in the back of your mind. And second, like you said, Sammy, they even position this as a scenario. This is one path where we could go. It's not a forecast or a base case. So kind of with those disclaimers out there, honestly, at first I was surprised the market reacted the way it did. I feel like unless you've really been living under a rock, that the concept of AI replacing jobs is not something that should be surprising people. So that and that's the gist of it. But when you think about maybe to get a little deeper into their case, they're saying that AI and robotics could replace jobs, especially white collar jobs. As a result, you see a tick up in unemployment. And as unemployment increases, then you have naturally more unemployed people. Unemployed people don't spend as much money, so it's a drag on the economy. So overall, it lays out a fairly negative environment. So as far as thoughts on that, one of the things that I would point out is when a company, if you really just try and play it out, like in reality, how does this happen? So if you take maybe two examples of businesses, I'll pick McDonald's as one. Everyone knows McDonald's, and say McDonald's starts hiring or building robots to replace, people taking orders and flipping burgers. And then maybe a different one to get into more like professional services. Think of a law firm and say they use AI in place of paralegals. And that's been talked about for a while now. In both cases, why would this happen? Well, McDonald's would, do crunch the numbers. Can a robot be purchased for a lower cost than it takes to pay people? So it would lead to greater productivity, basically, for the company, so that they get more output, more burgers and fries sold and Cokes, sold than it costs in wages. And the same thing with the law firm, that they would do it if they save in labor costs. So when you think of the implication of that, if costs go down for the company, then through competition, this is basic economics, because if McDonald's has these things, then I'm sure Burger King and Wendy's would follow suit. They would compete on price, and consumers would actually see lower prices because the wages to deliver the services go down. Same thing in the legal example. If rather than having a staff of paralegals, just some AI bot and a snap of a finger drafts a document, then the lawyers could charge less. So you'd have, as a consumer, goods and services would be cheaper. And then for those who are working and have assets and income, what we've also seen historically is that people aren't very disciplined with finances, and they tend to spend most of their discretionary income. So there would be a demand for more goods and services, and that, think of that as a void to be filled. So if you then think about what people would do, if you talk to an employer or business owner and say like, what are your challenges? Typically, one of the top challenges you hear is people in some sort or fashion, like finding good people, retaining good people, training people. A lot of running a business comes to challenges around people. And if you have AI and robotics that can do tasks, that helps alleviate that challenge. So it actually creates maybe a strong environment for entrepreneurs, where if you have a business idea and you can get old-fashioned labor at a fraction of the price, there's an opportunity, maybe even like the cost of entry, so to speak, to launch a business goes down. So I think there's both risks to this. I think the risks on the labor front are on more the large scale and more monotonous jobs like manufacturing, like car assemblies, and it's already happening. But then on the opportunity side, I think using this as a tool is exactly how I think of it. There's a lot of interesting things that can be done. So I know I've been monologuing here, but maybe I'll pause, see if you have any questions on that to start.
No, I mean, I think that's a great overview as I think about AI, and I know you and I have played around with those tools kind of quite extensively, just, from a personal standpoint, not necessarily bringing it all the way into our workflow because of privacy concerns with those models and things of that nature. But I don't, I didn't read this and felt like it was a base case of what would happen with AI, which to their credit, they're not saying, but just personally with me, AI has helped me be more efficient finalizing things when I had enough knowledge to know what I was looking for or could verify their answers because the answers I think there's a lot of inaccuracy. So it's almost like I needed to be um, extremely knowledgeable on what I was asking them to do to be able to verify that what I was getting back was accurate and also to be able to frame the questions the right way. Or on the flip side, it's great at providing basic research if you're just getting up and running on something and there's less risk for them to be wrong when they're, basically turning into a fancy Google inquiry or a Wikipedia one. But I haven't seen it necessarily replace whole scale the expertise needed to get things out of those tools. Now, I know they're progressing rapidly, and maybe that's short-sighted on my point, and AI could be running the world one day and we're all out of jobs, but there does seem to be still the need for knowledge-based interaction with those tools to get what you need out of it.
No, I completely agree. I think they are powerful tools, but I don't see it completely replacing humans. I mean, a personal example that I've done, we've been in our house for 14 years almost now. Took a picture of our kitchen and put it into the different AIs for some feedback, and it gave me a whole kind of idea on a kitchen renovation. And then I was like, well, who should I reach out to? It gave me some names. And AI is not coming in and fixing cabinets, so it's leading to work for people, but it helped me get there quicker. So I
But
think
you're not the white, that's not the white collar scenario. Do you think it replaces you? Do you think it replaces the person who drafted your estate planning documents? Do you think it replaces your CPA down the road?
no, I think it will make those people more efficient. Like I did recently do estate planning, and the attorney is awesome, and personally, I think I'd always want an attorney. but he's having, and just like in tax too, that you hear these professionals talk about it's hard to find people. And I know, like in the attorney's case, he was backed up because he lost paralegals. And I'd love for him to use AI tools, but still have the human blessing it. And like I said, maybe fees would go down too. Like I don't see C3PO opening a law firm and you just, right? Like I feel like there still needs to be some human
What
element.
about R2D2? I mean,
R2D2,
yeah, the language barrier there would be even worse.
he'd be doing my taxes.
Yeah.
No, but honestly, where my biggest concern with this comes is rising income and wealth inequality. It's already been a topic, and I think this will only lead to that to continue. So that in the case where a law firm might have 100 people today, maybe they can still be just as productive, but do it with 30 people. And the back office, the billing, the admin, the paralegals are now done by technology systems, but the revenue streams are about the same. So that type of, and I'm using rough numbers, but just directionally, less people, same productivity, lower cost structure. I do think that this could lead to further increases in the spread of wealth and income inequality. And then a downstream effect of that would be, especially given the backdrop that we've talked about with debt and deficits, higher taxes on certain the people who are doing well in this future state. And I can also see regulations getting involved. Like the government wouldn't sit back and let these things replace people without, getting their fair share. So maybe a tax on data usage or electrical usage, or you pay $10,000 in FICA per bot you have. Like I can see them creating frictions so people don't just get replaced by AI bots and the government doesn't collect a nickel, because that's another consideration that people pay taxes. If you have robots, robots typically don't pay taxes so far. So that's another angle to it.
One quick note, and then I'll follow up with my last thoughts on it. It references a 38% drop in the S&P from, I think, later this year to 2028. That's not particularly noteworthy. You don't need a research report to tell you that the market will drop 38, 40, 45, 50, 57% during the great financial crisis. So I'm certain we are going to get a drop of that magnitude at some point. And so that part of the kind of doomsday scenario didn't really do anything for me in terms of raising alarm bells. I just think, despite all that we're saying, it's reasonable to focus on AI individually. You need to learn it. You need to understand it. You need to know how to interact with it. You need to know how it could impact your career. If you're younger, you need to make AI a factor in the careers that you pursue. There's a wonderful movie I watched a few years ago. It's called Hidden Figures, and it's about these African American women working in NASA. And there's a lot of positivity to the story. But one thing that was interesting is that they had this team of women who were basically mathematicians. They called them computers, and they were just running all the numbers. And then all of a sudden, you get supercomputers. You don't need them anymore to run all these numbers. So they basically learned how to program the supercomputers and move from one unit to another. And I think about that when I read articles like this. It's not that there's, wide scale destruction of white collar jobs. It's that there are opportunities and dislocations that are created, and people need to understand that and shift over time and learn new tools and get the best out of those tools. And there's always going to be winners and losers in these things.
Yeah, no, I agree with it, and maybe said just a little differently is there's been technological disruption to the labor markets for 100 plus years. Like if you go back to 1900, the stat I heard was 40% of jobs were in agriculture, and now it's 2%. And if I said that's going to happen, oh no, what's going to happen to the 38% of people who lost their job? Well, they find other jobs. And even if you just look like in our careers, I was talking to a friend and he was talking about what he did in the 90s. He would rush into the office at 4:30 in the morning to read the news so that when this is in financial services, so that when the bosses came in, he could tell them what's going on in markets. And like that job's eliminated now, been long eliminated. I mean, I started writing out trade tickets with a pen and a piece of paper, and we don't need that anymore with technology. but we've found ways to hire people to do bigger and better things. So, jobs getting replaced from technology is nothing new. And if you look at the last 25 years, there's been a lot of technology, a lot of innovation, and a lot of jobs being replaced. And in aggregate, I think it'd be tough to argue that it hasn't been for the better. So I wouldn't be afraid of AI. I would embrace it, be familiar with it, and innovate with it, use it as a tool. And I am optimistic about the future.
Yeah, I am too. And it's a good point. In our industry, as things have become more efficient in terms of how we can deliver things to clients, what good wealth management firms have done is basically do more for clients, not hire less, right? Because you need to be competitive. You need to offer clients, the best services that you can offer within your capabilities. And as things and tools are laid out, you end up just doing more and adding more services, not delivering what we were delivering 30 years ago with a handful of people by comparison. And so I would imagine the legal industry and other industries that could be impacted by this operate the same way, or they should. So that's it on the Cetrini Research post. I guess your homework is you could watch Star Wars and see if you can envision C-3PO doing your taxes, and you can watch Hidden Figures and see how you can map out your career if you're feeling threatened by AI. So, two good movie recommendations. The other thing that's going on right now, Bob, is obviously this conflict in the Middle East. We're recording this on Tuesday morning. The markets are down about 4%, but I think about half of that was before this week, this event. But the volatility has cranked up. So, a lot of times we talk to clients and prospective clients in the moment about, hey, what are you doing with such and such macro concern or conflict concern? And we always say stay the course. So this is a real-time example of why do you tell people that, Bob, in environments like this?
Well, a few reasons. One, it's very difficult to market time and to say, take this news. And then if you were to say, okay, there's geopolitical events going on, and I'm going to conclude that I should go to cash. If you just pause and say, okay, time out. Why are you doing that? What do you know that other investors do not know? And it shouldn't take long to say nothing on that topic. So then if you just think about how markets work, for every buyer, there's a seller. So if you have your portfolio, you're going to sell it. Who's buying it? And on the other end of every trade, it's mostly institutional. So it's probably some hedge fund or investment bank involved, and you just don't have an edge. So market timing is just it's not it doesn't work. If you look a study I did years ago on tactical asset allocation funds. So there's a Morningstar category of funds that basically have a mandate of getting in and out of the market and timing asset classes. Collectively, in a non-technical term, my conclusion was their track records stink. Like they don't do well. And these are professionals who are trying to, follow the news like this and say, now let's get defensive or get aggressive. So there's just really no history of anyone successfully market timing. Some people get one call right, like might have called 2008, and then they get a lot of attention for a while, and here we are, 18 years later, and waiting for them to be right again. So that's just one broad point that market timing is very difficult. A second, maybe more specific to this, is if you look historically, geopolitical events like this one tends to be more short term in nature as far as affecting markets. Like there's frequently an initial panic, decline, but then the event tends to pass and markets recover. And that's exactly like how you get hurt by the initial decline, you panic, you sell, the event passes, markets recover, and you capture the downside and miss the upside. So, really, I think the thing to do is just be disciplined and not act on news like this. Now, the one thing I would add is we went into this latest event with pretty high valuations, and we've been talking about it, that the market's been basically priced for perfection. And we've said it's not good or bad, it's better or worse. And you go from high valuations with a lot of optimism priced in, and then you throw a negative headline at the market and it sells off. Like it's shouldn't be surprised. But then the question is, after it sells off, do you then sell? And if you're going to sell now, why didn't you sell before the sell-off? So I think the right thing to do is just stick to your strategy.
Stick to your strategy long term, and these things tend to not be as disruptive to markets in the short term, is basically what you're saying. And yeah, I mean, on a personal standpoint, I have family who live over there in the Middle East. They're in countries that are part of that State Department announcement for Americans to return home. And I've spent, the early part of this week thinking through with them what they should do, what their options are, what they shouldn't do. I've spent very little time thinking about the impact to our clients' portfolios because it's just not an investment conversation that should be had right now. You have a portfolio, you have a plan in place. That plan never envisioned that there wouldn't be conflict in the Middle East or a 4% sell off or a 2% sell off or oil prices rising. Like that these portfolios and these plans are built to sustain these short-term events. And so you focus on what you need to focus on personally, but you don't necessarily go in and tinker your portfolio under the illusion that you have control over things that you really don't have control over.
Yeah, I think that's well said. And one way I talk about it with clients is if you take a stock, so pick Apple, for example. Apple should be valued textbook, the present value of all future cash flows to shareholders. So take every nickel Apple will ever make for the entire existence of the company, discount it at a rate, and that's what it's worth today. And how much should this event impact Apple's future profits for the entire existence of Apple? And is it 4%? That's a pretty big number. And I don't know exactly how much it's down, but market, it's down a little bit today. And when you put it in that long-term view, the answer with events that move markets meaningfully tends to be more of an overreaction is the natural conclusion. But the news dominates headlines because it's affecting real lives. So it matters. Just leave it out of your portfolio is our advice.
So final topic for me, Bob, level one thinking, I would have imagined when I logged into CNBC that bonds would be rallying as a flight to quality. People get nervous about stocks. We see stock market volatility has ticked up. They go and they buy the 10-year treasury or some, government bond, but bonds have sold off and yields are up. Why do you think that is?
Yeah, so there's a few things going on. One is inflation concerns. So oil has been rising, and oil being an input cost for almost everything we buy, that could lead to inflation. And inflation and treasuries say don't like each other. In an
Yep.
inflationary environment, yields rise. So that's one potential. But I'll give you three answers. So call that one. A second is debt and deficits. So every time we have a downturn, a meaningful one, at least recent history, like COVID, 2008, the government comes with a bazooka and that there's stimulus, and the stimulus costs money. $1 trillion or so of stimulus, it leads to more government debt outstanding. And given where we are now with debt to GDP being at a pretty elevated level, if the market is sniffing this out and saying, oh, just from a military standpoint alone, like there's more spending. And then if this does turn into more of an economic downturn, there will be even more stimulus spending. So basically, the US fiscal house would be getting worse, so to speak. So that by itself is a reason to say, yeah, I don't like treasuries as much today as I did last week because the US is going to be spending more money and taking in less revenue. So I've heard that from some pundits that during the next downturn, with how much debt the U.S. has, that treasuries won't be as strong, and so that call that behind door number two, and then the other consideration would just be liquidity. That people panic, they hit the sell all button, they go to cash, and maybe rather than trying to be cute and buy some long-term treasuries, it's just get me out, I want cash. So the flight to maybe not quality, but the flight to liquidity. So those are all the three things. Unfortunately, the market never gives you a memo as to
Mhm.
why everything moves the way it does on any given day. But I also would add that treasury yields have been ticking down, prices up overall for the last few months, with the 10-year had been in the like 4.1, 4.2, 4.3 range, and then it got down about 4.0, and now it's up to 4.1. So it's still pretty much range bound.
Okay.
So it's
So
also,
not a major move, even though the direction is a bit surprising, or
yeah,
on the surface, the direction might be a bit surprising.
but it is interesting. I do look closely at asset prices on days like today when you have big moves in equities. It is interesting to kind of take out the magnifying glass and look how everything else is reacting, and seeing a big down day in stocks combined with just directionally treasuries selling off is a little unusual, but it still is one day. And to draw a bigger conclusion, I'd like the markets to go down for weeks, but to
Yeah.
see a little more data before jump to conclusions. But those are three of the reasons that I think could be playing in.
So as of now, no concerns with the fixed income allocation in our portfolio.
No, and I'd add, with treasuries being down today, rates up, the longer your duration is, the more sensitive you have to price movements, and we keep our fixed income more on the short to intermediate end. So it's like our duration is less than the 10-year treasury on average. So it's not really a big move for our investors within fixed income.
Got it. All right. Well, thank you, Bob. A lot to talk about this week, and I appreciate you joining me as always. And I know our listeners enjoy hearing from a chief investment officer. Thank you.
Thanks, Sammy.
Thank you for listening to Wealthy Behavior. If you found the conversation useful, please leave a review wherever you listen to your podcasts and share this episode so those around you can live a rich life too. We appreciate your feedback and questions. Please email us at wealthybehavior@heritagefinancial.net. For more insights, subscribe to our weekly blog at heritagefinancial.net and follow us on Facebook, Twitter, and LinkedIn. Check out my personal finance blog at thebostonadvisor.com. Wealthy Behavior is produced by Kushel Kakamis.
This educational podcast is brought to you by Heritage Financial Services, LLC, located in the greater Boston area. The views and opinions expressed in this podcast are that of the speaker, are subject to change, and do not constitute investment advice or a recommendation regarding any specific product or security. There is no guarantee that any investment or strategy discussed will be successful or will achieve any particular level of results. Investing involves risks, including the potential loss of principal. There has not been and will not be any compensation exchanged between Heritage Financial Services and podcast guests or recommended resources.